Hi, everyone. Thanks for joining us for part three of our ongoing series on preferred stock financing. So in part one of this series, we discussed everything that happens before the company receives a term sheet. And we did that with my colleague John Bautista and Neil Delani. In the second part, we started getting a little bit deeper into the legal rights that investors usually ask for in these financings. And the rights that we discussed, again, with my colleague John and Laura Bloxham, were rights that I would put in the bucket. These are rights that are attached to the preferred stock that investors get. So if an investor sells their shares to a new investor, those rights kind of go along with them. And in this third and final part, we're going to get into some more of the legal rights, the significant ones. And these are rights that I would characterize as being personal to investors. So if an investor sells their shares to a new investor, these rights don't necessarily go to the new investor. They may actually kind of wither on the vine at that point. So with that kind of background, let's get into it. Again, joining me are John Bautista and Laura Bloxham, my partners in our technology company group. John, Laura, welcome. Thanks for joining us again.
Thanks, Aria. Glad to be here.
Likewise.
Okay, let's get right into it. John, I'll ask the first question of you, and this one is about what are commonly known as pro rata rights, preemptive rights, participation rights, right to first offer, all of them being the same thing, really, and just meaning that they're rights for the existing investors to keep participating in future financings of the company, and I suppose the idea is to keep their ownership percentage of the company without being diluted further. So I'll hand it over to you. Is that a fair description of it? And what are some issues that typically come up?
Yes, that's a fair description. And these sorts of rights, are commonly contained in an agreement called the Investor Rights Agreement that we see as part of the standard agreements that accompany the venture financing documents. And that's exactly correct that pro rata rights, preemptive rights, rights of first offer all mean the same thing. And the investor has the right in these cases to maintain their percentage ownership in the company. In most cases, sometimes investors negotiate super pro rata rights where they may be able to increase their percentage ownership of the company. Either that's negotiated up front or they have the right to take over non-exercise pro rata rights of other investors. But the general principle is investors, at a minimum, in particular major investors, are looking to maintain their percentage ownership in the company. And what that means for the company is when the company is doing a subsequent round of financing, if the investors are exercising that pro rata right, the company will need to allocate a portion of that next round to accommodate the existing investors. So for example, if the company's raising a Series B financing and it's a $10 million round and the pre-money valuation is $40 million, the post-money valuation is $50 million. And let's suppose that investors who have pro rata rights own 20% of the company. And that's usually calculated based on their percentage ownership of the outstanding shares and outstanding options in the company. If investors own 20% of the company and want to maintain their 20% ownership after the financing, that means that they would have the right to purchase 20% of the round. So if the round is a 10 million round, they will have the right to purchase $2 million of the 10 million, leaving $8 million remaining for new investors. It doesn't mean that the investors have the right to purchase 20% of the company. In that case, it would be the full 10 million, since 10 million is 20% of the company, but it's simply to maintain their percentage ownership in the company. As you can see, managing pro rata rights can become quite complex. And when investors exercise pro rata rights, it can cut back the amount of percentage that's available to new investors. As a result, we recommend founders limit who the investors are who receive pro rata rights. And typically, as part of venture financing documents, there will be a minimum ownership threshold that says that only, quote, major investors have the right to participate in future rounds of financings. Now, sometimes prior investors have negotiated side letters and or in safe agreements, there may be a pro rata right provision or a pro rata side letter. In those cases, companies need to honor those pro rata rights. So we see many companies where the new investors have pro rata rights subject to the share ownership threshold. And then prior investors, if they've negotiated side letters with pro rata rights, they're carried along and will have pro rata rights regardless of their ownership structure. The recommendation, however, is to guard pro rata rights very carefully and to, from the very beginning, as the company is obtaining financing from investors, safe financings, seed financings, is to limit the investors who are entitled to pro rata rights.
Yeah, and the other reason to limit the investors, John, that I think we tend to counsel companies around is the way that this plays out in actual financings. Notwithstanding the fact that when a company is raising a new round, you're going to go to your existing investors and try to get a sense of who wants to participate and how the round is going to be syndicated and come together. And you need to be respectful of any outstanding pro rata rights in that syndication process. We will, as your lawyers, typically put a formal pro rata rights waiver into the consent documents for the financing. So on paper, it will look like the pro rata rights are all being waived in consent in connection with the financing, notwithstanding the fact that some or all of the existing investors may be participating in that financing. And maintaining a simple ability for the pro rata rights to be waived provides the company with operational flexibility going into your next fundraising to be able to negotiate that syndication and know that with 2 or 3 investors at the table, you can get the waiver in place that you need to technically on the legal documents get to closing in the financing and sort of work out the syndication and participations piece behind the scenes. So what we like to see in the investor rights agreement from a founder perspective is pro rata rights that can be waived by a majority of the shares holding those rights or a majority of the major investor shares. One of the complexities with having pro rata rights housed in a side letter, whether that comes from a prior financing or a safe investment or something else, is sometimes those side letter pro rata rights cannot be dragged along into a waiver by the majority of major investor shares. And so if you have pro rata rights that arise pursuant to different documents and different instruments, actually getting the signatures on paper, the consents that you need to close a round of financing can become more complicated down the line versus trying to limit that number of investors, but also streamline the rights into a single document with a simple waiver threshold.
Yeah, I would add, it's a floating target because as the round size changes, whether it goes up or goes down, the pro rata rights percentage of that round, results in a different number. So that number can always be in flux. And, the pro rata rights holders themselves, that number that they elect to purchase is included in the round size. So it's really important to maintain a good spreadsheet, to know precisely what an investor's pro rata rights are and to get ahead of that early on in the process. So there's not a mismatch in expectations between what the investors think they have the right to purchase and what actually they do have the right to purchase.
Yeah, those are great points. The company's going to want to get ahead of that, like you guys both mentioned, at the very beginning of the financing process, so they know who they can go to get that waiver that Laura mentioned, because that speeds up the financing by a lot. And as everybody knows, time is of the essence, very much in a financing transaction. So picking up on that threat of major investor, that is one concept that you see carried through a bunch of these rights. And one of them is what is called an information or inspection right. Usually those are, in my experience, given to major investors, although of course they can be given to more people. Laura, maybe you can explain a little bit about what those are and what, again, the implications are of who gets them.
Yeah, absolutely. So this is another right that arises typically pursuant to the investor rights agreement. And the information rights are a requirement that the company deliver a set of financial statements to the investors on a regular basis. Typically, it's a quarterly cadence, although sometimes we see a monthly cadence with respect to the financials, especially for early stage companies. And that includes a income statement, balance sheet, statement of cash flows. For early stage companies, those would be unaudited financial statements. But as the company becomes a little bit more mature and gets to a later stage of fundraising, we'll often see, at least with respect to the annual financial statements, requirement that you engage auditors and provide audited financials to the investors. Sometimes the financial statement delivery requirement also requires provision of a quarterly cap table. And all of this is in service of the investors monitoring the value of their portfolio companies over time. They will use the financial statements and cap table received from the company to try to get a sense for their own internal audit purposes of what the value of the investment and the position, the number of shares of stock held in the given portfolio company is. So a very standard thing that's provided to a subset of investors, typically the major investors, under the investor rights agreement. And the piece that goes along with that is something known as inspection rights. Inspection rights are the ability of the investor to actually come down to the company's offices to meet with the management team, take a look through what's going on at the company, and to do that sort of on a regular basis. Inspection rights are very, very infrequently used in practice. Companies will work with their investors to find appropriate times if investors do want to be involved and getting a picture of the day-to-day operations of the company. It's rare that somebody would just show up and say, hey, I'm invoking my inspection rights, show me around the office. But it is considered a standard part of monitoring the investment for venture funds and a standard right that's included in the investor rights agreement for major investors in almost every transaction.
And these rights are negotiable. Sometimes investors will ask for more. They'll ask for a cap table, very detailed, providing ownership information about other investors and employees and founders. Sometimes they'll ask for a business plan to be provided annually to the company. So these, are all subject to negotiation. There are investors who have accepted funds from limited partners who are ERISA registered and monitored investors that have statutory information requirements. And in those cases, the bare minimum is the annual and quarterly financial statements, but the rest are overall negotiable. And as Laura pointed out, we try to limit this to major investors. Bear in mind that this is a right that investors have. Board members will have access to this information and more, but even your investors who are not represented on the board, if they're major investors and have these information rights, they will, receive the financial information. And if you've negotiated with them, business plan and other information, which could contain, highly sensitive, confidential information. And the best way for the company to manage this is to limit, the sensitivity of the information that is being provided to the investors. Make sure these are investors that you know and trust. If the investor is a strategic investor and can potentially end up being a competitor of the company, then we many times will exclude that investor from information rights, or provide that if the investor is deemed by the board to be a competitor, then they do not any longer receive these sorts of information rights.
That's right. And John, just one quick thing. You mentioned ERISA, which of course is the Employee Retirement Income Security Act. Who are those ERISA investors that you mentioned typically, just so the viewers are aware?
Yeah, typically those are pension funds, state pension funds that are required to have information passed through to them for the portfolio companies that they're invested in.
Yeah, exactly. And of course, a lot of these major Silicon Valley funds and other funds have those types of limited partners in them that are investors in those funds. So while people might not think they're dealing with a pension fund, that's a great point, because a lot of times those are present in the background. That's where a lot of the venture money comes from. Well, that's great. Let's move on and talk about another right that gets negotiated. This one's an interesting one because it gets negotiated from very early stages in a company's life. even though it doesn't really become much relevant until much later. And sometimes in Series C, I think you would agree that you don't even sometimes see this right, and it's called the registration rate. So John, maybe we pick up with you again, and maybe just let us know what exactly is being registered, and what is this right, and how does it all play in? And we'd love to get Laura's thoughts on that as well.
Well, registration rights typically come into play when a company's going public and after the IPO. And there's three forms of registration rights. The first one is demand registration, where a percentage of the investors can demand that the company actually go public. It's very rare to see that happen. Going public is going to be a function of a lot of factors, including whether investment banks will support the IPO at a particular point in time. So we very rarely have seen investors trigger the demand registration rights to go public. The second registration right is referred to as a piggyback registration right, which says once a company decides to go public, the investors have the right to sell their shares alongside the company's IPO shares in order to get liquidity. And this would be ahead of the expiration of a lockup. And that's usually subject to banker discretion, whether or not there's room and whether it makes sense from an IPO marketing perspective to include insiders who have shares in the IPO itself. So there's certain carve outs or exclusions to the investor's ability to exercise their piggyback registration rights. And the third is so-called S3 registration rights, which give the investors a path to liquidity, usually after the expiration of the lockup and after a 1-year period following the IPO.
Got it. So what's being registered are the sale of the shares of the company. That's what it refers to. That's and those are the three flavors of it. Laura, what are your thoughts on this right?
I want to touch back on this concept of a lockup, which John mentioned a couple of times, because understanding registration rights, especially the S3 registration rights, it makes more sense against the backdrop of the lockup. And so when we think about an IPO, a lot of people think of that as a liquidity opportunity, which it can be, but it's first and foremost a fundraising opportunity for the company. When companies go public on the markets, they're looking to raise money through the primary sale of shares on the market, typically as the first order of business in the IPO. And in order to make sure that the company is raising, the most money that it can via the IPO, and that the share price is being set as advantageously as possible for the company in the IPO, the insiders, anyone who owns stock prior to the IPO, will typically sign an agreement that they will not sell their shares in the IPO or for 90 days following the IPO. In most founder stock issuance documents, almost all employee stock plan participation documents, and almost all investor rights agreements, there's a covenant that when you acquire shares in a private company, you will agree to a lockup in an IPO and agree not to sell your shares for those first 90 days following the IPO. Now, sometimes you can negotiate carve-outs with that in connection with the IPO itself. That would be something to negotiate with the investment bankers. But the sort of default position is that insiders are not going to sell their shares for the first 90 days following the IPO. It's an important point to be aware of as a founder, as an investor, as an employee of a startup company. And the reason that we most often see S3 registration rights in practice is that the investors are not participating in that IPO. They're not forcing the IPO. The purpose of the IPO is to raise proceeds for the company. But then once the lockup is expired, the S3 registration rights after some period of time kick in, and the investors can at that point force the company and the investment bankers to work with them to help sell the investor shares.
Yeah, got it. And that's why it's interesting, because at the beginning, in Series A financing, no one's really thinking about any of that, even though this gets negotiated, and it really becomes more important as the company becomes more matured and IPO becomes a possibility. That's great background. Thank you. One other right I want to ask you about is something related to that major investor concept again, usually, and that is, and it kind of sounds like the pro rata right we talked about, but it's different. and it's called the right of first refusal, as opposed to the right of first offer, and a related right called the co-sale right. So maybe we can briefly chat about that as well. Laura, do you want to kick us off and let us know what those are, and we'll get your and John's thoughts on those.
Yeah, happy to. So the right of first refusal and the co-sale right are housed in a separate agreement called the right of first refusal and co-sale agreement. And those rights apply specifically to transactions in founder shares. And so if a founder who owns shares of common stock of the company would like to enter into a transaction to sell some of those shares, typically the investors, often it's just the major investors, but sometimes it's the full cap table of investors, have the right to either step into the shoes of the buyer and buy those shares from the founder, that's the right of first refusal, or to tag along with that founder sale and sell some of their investors' shares alongside the founder's shares. This type of right almost always attaches to the common stock held by the founders, and oftentimes it'll be a little bit broader than that. There'll be a definition of key holder, which is someone who holds more than 1% of the common stock of the company. So in addition to founders, think about people like early employees, key executives who join the company later. Anyone who holds a really significant portion of the company's common stock is likely to have their shares subject to this investor right to either step into the shoes of a prospective buyer if that individual is looking to do a secondary sale of common shares, and or tag along with the secondary sale of common shares if the investor wants to receive a portion of those proceeds themselves.
John, do you have any thoughts on those? How often are they used? What happens in a typical secondary transaction?
Yes, usually with these rights, the company also has a right of first refusal, has a right of first refusal over the shares. So they need to be offered first to the company. So many times the company will, in the case of an employee or founder selling shares, first decide at the board level whether the company is going to be the party repurchasing the shares. But if it decides not to proceed, then it will be socialized among the major investors, whether they want to purchase the shares. This is an opportunity for investors to increase their pro rata ownership in the company because new shares are not being printed. What we're talking about here is how shares get distributed between the investors. This is all triggered when a founder or key employee has a third-party offer, and the company, if it's exercising its right of first refusal, or the investors, if they're exercising their right of first refusal, is required to purchase the shares at the offered price. We also have a number of exclusions that we focus on when we're negotiating these provisions for the founders to make sure that if it's a de minimis sale, or if it's a transfer to family members or a transfer for estate planning purposes, that it does not trigger these rights of first refusal. So our advice when negotiating with the investors is to make sure to also focus on the list of exclusions.
Yeah, and my experience, and I wonder if your experience is consistent with this, but I suspect it is that while these rights exist, the investors don't usually, the situation doesn't usually come up where the investors actually exercise these rights, because a lot of times if founders or these quote unquote key holders who are subject to these rights want to sell their shares, that's usually either part of a pre-planned liquidity process that the company is putting together, or there's been some discussion already with the investors. They're supportive of, the founder, for example, getting some liquidity if they have a major life expense of some sort. And sometimes you see the investors even buying those shares, like you said. But again, do these rights get waived, or does the key holder, should they plan to go through the process?
Yeah, there's a number of conversations, as you point out, that happen ahead of time in terms of what's in the best interest of the company. Usually the major investors who have the right to waive these sorts of co-sale, right of first refusal, co-sale rights are also on the board. So discussions usually happen at the board level first. And as you pointed out, there's multiple paths to liquidity, and many times the rights get waived and the founder either sells to the company or sells to a third-party investor.
I agree with that. And I think the bottom line here with the ROFR and co-sale rights, it's the same as with a lot of other rights, the pro rata rights, the IPO related rights, is not that these rights are going to sneak up on you as a gotcha, where the investor comes out of the woodwork and is like, by the way, I have this right. It's that it's important to have the right conversations with stakeholders on the front end. If a founder is looking to engage in a secondary sale, there are a number of insider parties that they will need to get internal buy-in from before being in a great position to proceed with that secondary sale.
Yeah, that's a great point. So I think between all these points that we talked about in this part and what we talked about in part 2 of this series, we've probably covered all the significant rights that get negotiated in financings, I would think. So as the last parting request for you two, I want to get your thoughts on what are some pitfalls, maybe like your top 1 or 2 worst things you've seen mistakes founders have made in financings, and maybe let us know for the benefit of our viewers here.
So 2 things spring to mind for me, and both of them have to do with just making sure as a founder, if you're preparing for a fundraiser or starting a fundraise, that you're prepared and really understand what's going on at the right stage. So my first tip would be careful when you're raising convertibles to make sure you understand how the conversion math works. The most common form of SAFE in the market today is a post-money capped SAFE, which is great. That's an instrument that works well, but can be a little tricky for founders, particularly if you're raising on multiple series of SAFEs. Even if the caps are stepping up, they can end up having a more dilutive effect at conversion than founders expect. And so really having a good understanding of the math around your convertible instruments, both when you're out raising on those instruments and as you're going into a fundraise, really knowing on a concrete and modeled basis what your dilution is as a founder from your different fundraising instruments is really important going into a fundraise. And the other piece, and this may sound self-serving, but it's don't call your lawyers too late. I hate when someone calls me up and says, hey, great news, I signed this term sheet. Because oftentimes I'll look at the term sheet and think, well, I probably could have gotten you a better deal here. And even if I couldn't have gotten you a better deal, I certainly could have made sure you understood some of these terms that you don't seem to understand. And so term sheets are complicated. You know, there's a lot of sort of special language and niche concepts to what we do as startup lawyers. And if you're engaging in a fundraise, the right time to talk to a lawyer about that is either before you've received a term sheet or right when you receive a term sheet, because our job is to help you negotiate and make sure you understand the terms you're getting and that you're getting the best terms that you can. Once you've signed something, it's a little bit too late.
Yeah, certainly. That goes to a point I think we made in one of the earlier parts of this episode, which was the company has the most leverage at the term sheet negotiation. After that, it will be very, very hard to move off the term sheet. So that's great one, and one point that is near and dear to my heart as well. John, what are your thoughts?
I would add that consulting your lawyer early on the process makes sense to understand not only the legal terms, but as Laura pointed out, the economic terms, because in the example I gave earlier, where a company is looking to raise $10 million at a 40 million pre, 50 million post from an investor, the founder may think, okay, I've offered a new investor or group of new investors $10 million, and therefore it's going to be only a 20% dilution for me. However, there's pro rata rights that need to be exercised. There's safes in existence or convertible notes that need to be converted. There's stock option pool that needs to be negotiated, and not fully understanding all the different inputs that go into the economic model means a founder could end up with greater dilution than they expected. So even the economic terms are important to understand, and they can be quite complex and more complex than simply saying, I'm offering a new investor 20% of the company, therefore I'm only going to be diluted by 20%. That's almost never the case. And then on the legal rights, many investors, as we pointed out in earlier segments, will not go into great detail in the term sheet as to what the legal rights are, and will insist that the founder sign, the term sheet on the back of a napkin or a one-pager, but to the extent possible to have more detail in the term sheet so you can understand what veto rights the investors may be requesting, or what other rights are out of market that they're requesting, and get those hammered out before signing up to a 30-day no shop or exclusivity provision with that investor, is when you have maximum leverage at that point in time. Choosing an investor is very important, particularly the lead investor. They're going to be a long-term, and you want them to be a long-term partner in your business to help you grow your business, to be flexible as things arise, and to continue to invest in your business. So making sure an investor has deep pockets, who can support the business in future rounds of financing is very important. I was just on a call earlier today with a founder who said, our business is not growing as quickly as we expected. The major investor wants off the board. They don't think it's useful to be on the board. I'd like to boot them from the board anyway and not have to deal with them anymore, not have to communicate with them, and not have them be a part of the company. That's not realistic. In this case, the investor owns more than 50% of the preferred stock. So in fact, any major event, whether it's a next financing round or a sale of the company or a sale of assets, is going to require investor consent. So it's important to keep the major investor up to date and to maintain a constructive relationship with that major investor.
Definitely. All definitely great points to be mindful of as founders move through the process. So thank you again, both, for sharing your time with us and your expertise through this part and the last part, and John, the first part of the series as well. And I look forward to continuing other conversations with you on future episodes. Thanks again.
Thanks, Aria.